Well, good morning, everyone. Thank you for coming to this chat today. And it's going to be quite a lot of impactful information being shared, so be prepared to be mind blown by the information I'll share today. So today we're going to talk about token audit. And to get everyone started, this is the general outline of what we're going to cover for 15 minutes. We're going to show what are the types of due diligence and audit there are in the space. You probably know two of them, and the third one will be interesting. The second is a Web3 economic growth journey. Just like what we have in seed stage, Series A, Series B, what does that look like from an economics perspective, economics considerations when we are designing Web3 ecosystems? And then we talk about the three different economic pillars because that's how we're going to do audit, that's how we're going to do due diligence. Then lastly, we're going to look at the different risk metrics and examples of risk metrics. So with that, we're going to get started with the different types of audit in place and different types of due diligence that people think about. And the first two you probably heard a lot about. It's technical and financial. With technical audit, this is all your smart contract audits. These are to check the code, this check the bug. You want to understand, is there logic in the execution of the smart contract of the code? And this is stuff that's really very established, and you have a lot of established projects out there. And this usually happens after you finish coding, and then at every different stage, maybe every year or every quarter, you do a different evaluation audit. The second thing is financial audit, and financial audit is nothing new. We see financial audit in Web2 systems as well. You have different KPMG, you have the Big Four doing all these audits. So the way we do financial audit in Web3 is not that different. The last one, though, is very new. The last one is economic audit. And economic audit is very new in the Web3 space because in Web3, we need to build our own economic models. We build our own economic logic. And what is this economic logic trying to do? It's to drive two things and two things only in your ecosystem: user acquisition and user retention. We change the economic logic when we're at different phases and different stages of the economic growth, of all the platform growth that you have in your Web3 system. So what does that look like from a growth trajectory? I like to divide things into three components. You have 0 to 1, 1 to 50, and 50 to 100. So 0 to 1 is kind of like a seed stage in any of these traditional Web2 startups that you see. And here you want to optimize for user acquisition. The economic consideration over there, what do we have to consider when we're building the economy? It's a minimum viable economy. So when people talk about launching a startup model, launching a raise of hands if you have a token project. Okay, a lot of you guys have. And when you're launching a token project, usually people do a lot of simulation. They do a lot of agent-based modeling. They do a lot of CAD modeling, which is fantastic, by the way. But these are all simulations. These are all assumptions to figure out what is a minimum viable economy that works in a 0 to 1 phase. In a 0 to 1 phase, you want to go to product market fit, you want to get market validation, and you want to acquire a good amount of users and using tokens as an incentive. So the way we look at the complexity over here of doing economic audit is more minimal. It's understanding if you're doing a lot of simulations in place or you have different kind of Excel models, you want to understand what is the logic behind, what is the assumptions in place, are these logics sound, and how do they correlate to the different kind of economic policies you have in place, or tokenomics that people call. But tokenomics is not just the token value itself, not just the inflation rate, the interest rates, but token is also about all the different incentives in place to drive user acquisition, to drive user growth, to drive interaction between users, between each other, EOAs, or between users and smart contract. So that's all in the phase 1, 0 to 1. And now your project's out, your project's launched. And when your project's launched, do you still want to do a lot of simulations? You don't really need that much simulation because what you want to do over here is to understand how users are behaving in response to the economic incentives you have. And so from 0 to 1, your goal there is to drive user retention. And your main consideration for economic growth is really to create a self-sustainable economy, and you want to understand what is the intrinsic demand drivers, the user behaviors, that's correlated with your economic incentives in place. So here the complexity is a little bit moderate because we need to understand, given the live data that we have, given that the projects are all live, we want to correlate between or look at correlation or causation between the economic incentives we have, driven by tokens, and how users are behaving with respect to the incentives you have in place. And lastly, it's 50 to 100. This is where your project gets more mature. And here we want to understand how do we drive long-term value growth, value capture in your system. And it's all driven by the incentives of the tokens. And here, the complexity can be a bit more challenging because, yes, we have done a lot of analysis on the 1 to 50 phase to understand how users behave with respect to the incentives you have in place. And in the first phase, we have a lot of theories, we have a lot of simulations. Now we need to combine both together to start growing and developing this very complex economy. So if we take countries as an example, when countries are in early stage, it's a lot easier to develop the right kind of incentives in place. As the countries get more mature, you have different immigration policy, you have different market structure, you have different people coming into the space, you have different, it could be a very entrepreneurial focused economy, or it could be an economy that people like to join, like social, like the government or medicine or the police, where it changes the incentives of how people behave. So with that in mind, how do we evaluate the economic risks? Whether you're in phase 0 to 1, 1 to 50, or 50 to 100, we want to evaluate the economic risk from a macro to micro structure. And the macro structure starts with the market design. So the market design here is to understand the characteristics of the entire economy. You want to understand the different factors that could influence how the protocol behaves and how the users behave within the protocol. Because we can't just assume that people behave rationally and people will keep depositing and their assets into your protocol to increase the TVL because you're just giving out tokens for free. But there are other considerations that people take in mind and behave and act and move their tokens around. The second thing is mechanism design. Mechanism design looks at the rules that need to be followed. When we create an economy, or we create a system, we define what the market is, so how do people behave within the market, and then we need to create the rules of how people interact in the market. What are the rules that people can do with each other or with the smart contract, and what they cannot do. And this is part of analyzing the risks as well, because the risks here are to analyze what are the rules of how people can follow, and are these rules sound, are these rules written properly, are these rules scalable, will people follow these rules? And lastly is the token itself. With any economy, with any system, when people are trading and interacting with each other, they need to trade something, they need to exchange something. It's like Christmas Day, you need to exchange presents with each other. But in the digital world, it's not always tokens itself. It's not always physical goods. It can be tokens, it can be tradable tokens, non-tradable tokens, non-fungible tokens, fungible tokens, it could be currencies. And all these assets need to have a rule that they're governed by, a rule that dictates what their behavior is, their intrinsic behavior is. So this is how we analyze things from a macro to micro perspective, from market design all the way down to token design. So if we want to analyze and we want to do audit of how economies work, we need to first understand how economies are being designed. When we know how they're being designed, we know how they can work, and then we can just almost like reverse engineer them to see how well they behave. So this is the framework that we've created, looking at the 3 key pillars that we talked about just now again, from macro to micro: market, mechanism, and token design. Again, market design is the structure of the market, the constraints of the market. Who comes into your market? Who comes into your Uniswap to trade? Who comes into your ecosystem? What kind of people? What kind of economic agents? And who gets to participate in these markets? Mechanism here will be the rules that people need to follow, the rules that people need to abide by when they're trading with each other or with the smart contracts you have in place. And lastly is the token. The tokens are the assets that you're using to trade and transact with each other. What are the rules the assets need to follow? So to make it very simple, the first part of market design are the rules of the market, the rules of the ecosystem. The second is rules of how people behave in the ecosystem. And last one is the rules of the assets being transacted in the ecosystem. So we look at economic risks, we look at these 3 key pillars, and then dive into them to understand from a macro to micro perspective. We've done all the considerations of how economies are being structured, economies are being designed, and economies are being evaluated from a risk perspective. So what we want to do at the end of the day is to measure economic health. What is the risk exposure of this protocol, considering that we are designing all these rules from scratch? So when we're analyzing and reviewing the risks, we are doing audit or due diligence to the economic health, we want to understand what are the potential risks in place. So let's get started with the various kind of risk metrics, and I'll give you specific examples. So a risk from a market design perspective, we looked at 4 different key categories that we showed just now in that chart, on that diagram. We have thickness, congestion, ease of use, and safety. So thickness is really how attractive your ecosystem is. And remember, I told you from 0 to 1, it's user acquisition. So how do we drive user acquisition in the space? How do we use tokens to do that? How do we use other incentives to do that? How do we use whatever system that you have or whatever tools you have in your ecosystem to drive thickness, to drive attractiveness of your ecosystem to attract people into the space? With congestion, we're looking at economic activities. We want to understand if this is the space that our users can interact with, what are the economic activities that are being transacted, and just analyze and define the parameters, almost like a demographic listing of what activities are, who are driving these activities. Are there primarily whales? Are there primarily governance token holders? Are there primarily stablecoin holders? This gives us an understanding of who are the economic agents in the space and how do they behave with respect to what are their preferences and interests. And when it comes to ease of use and safety, ease of use is how easy it is to use the system. And then we also want to think about ecosystem stickiness as well as user retention. So user retention is what we look at primarily in the 1 to 50 phase, because in the first phase, you give out a lot of tokens. Token farming or yield farming and any kind of systems and incentives out there to drive a lot of users into the space. But that is not enough. You have a lot of people coming into your ecosystem, but if no one is using the ecosystem, no one is staying there, no one is repeating the interaction in your ecosystem, then your ecosystem is going to die after you finish your token subsidies. So how do we drive the ease of use? How do we drive user retention? How do we drive stickiness? This is all part of the designing of the entire macro system, macro market, of the protocol. And lastly, safety. Things to consider will be things like your extraction, the value extraction rate. Because when we talk about economics, we talk about two key ways of value. We have a short-term value and long-term value. In the short-term value creation, people are also extracting value in the system, whereas in the long run, we want people to invest in the system in the long run, we want people to stake longer, we want people to have skin in the game in the future growth of the protocol. So when we look at safety, we don't just look at safety in terms of smart contract risks, but how safe people feel in investing their tokens in the future. Investing not in terms of expecting huge financial returns, but really investing in the growth and the community strength of the ecosystem. It's all about economic growth we're talking about here. So there's everything in market. That's the big macro picture. Now we go to mechanism design. In mechanism design, these are the rules of how people interact and trade with each other. And here we look at governance, non-financial incentives, and structure. And you realize I haven't even touched about tokens yet. So governance, when we talk about governance, everyone's talking about creating a DAO, using Gnosis to create your DAO structure and having on-chain different verification and multi-sig and things like that. That is very great. The other thing about governance is also how do you punish bad behaviors? Governance provides the structure of how people interact and the rules they need to follow, how decisions are being made, but we also need to start punishing bad behaviors because economics, everything we're talking about is what are the incentives to drive people's behavior, or what are the disincentives to impact people's behaviors. And governance is where disincentives can come in because you need to punish the people who are not acting in good faith in your ecosystem. So for example, people who are constantly extracting value in the midterm, they come in, they extract value, and they get the token, they dump the token out there. This is not the right kind of activities that we want. And you can analyze a lot of these from an economic risk perspective. It gives you the lens to start thinking about all the different potential risks that you see, the midterm and the long term. With non-financial incentives, we have things like a lot of other monitoring activities related to, we can look at soul-bound tokens, we can look at NFTs, we can look at things that are not financially driven to help and to look at how people behave, how are people reacting to these different non-financial incentives in place. And structure here, we're talking about what is the, for example, bargaining structure. How do people agree with each other to trade and interact with execute any trade? So there could be auction theory. And auction theory, yes, there are some tokens being considered, but how robust is this auction? Is this auction something that people can cheat? Is this auction a first price auction, second price auction, English auction, Dutch auction? These different auctions can have different implications, not just primary implications, but secondary and tertiary implications of events that could happen because you have these incentives in place. And lastly, we have tokens. Tokens, we look at token policy, financial incentives, and architecture. We talk about token policy. It's kind of like monetary policy, but not all tokens are money. So taking the monetary economics concepts in place, how do we evaluate the policies, the rules that tokens abide by, and tokens live by, and tokens have to follow, and evaluate that risks from there? With financial incentives, that's probably quite a no-brainer. With tokens, you have different kind of financial incentives in place, and how do you evaluate them? The most important thing that we're looking at over here as well is not just the primary impact of the behaviors when you have these incentives in place, but the secondary and tertiary events that could happen because of the token incentives that you have. The primary impact could be very useful, could be to drive retention, could be to drive user acquisition, but the secondary impact is that you're driving the wrong kind of user retention or the wrong kind of user acquisition. So for example, you can have an incentive, a financial incentive that drives user growth, and they help to create a referral program because it's a marketing kind of DAO. But because of the incentives in place, you realize that you're attracting the wrong kind of people. You're attracting the people who are extracting value in the long run. And they're not really contributing, they're not adding value in the long run. And that's a big potential risk in the secondary and tertiary behavior and events kind of outcome. So with that in place, I want to show you some examples, some bit more realistic examples of what that could look like if you're trying to measure risks from the market, mechanism, and token design perspective. So a very simple, easy metric that we can look at from a market perspective. Again, the market is the macro picture, understanding the market structure, the economic agents, what they can do, and listing down what they can do, they cannot do, what the behaviors are, what are the behaviors we want to incentivize, what are the behaviors we want to disincentivize. So here we can look at the user retention rate, the user churn rate, and the user acquisition. This helps us to analyze the market thickness of this system. Whether there are a lot of, is it growing in market size? Are people using the system a lot more? Are people finding it safe? Is there stickiness? Is there retention? Is there longevity in someone coming and joining the system? Because if there is a high user acquisition rate with a low user retention rate, then that's not a very meaningful ecosystem to want to be participating in a lot, because people are just coming in to get value and then they're leaving. So user retention becomes a very important metric to look at as well from a macro market perspective. The other one will be, the second phase will be the mechanism design. Remember, mechanism design are the rules that we have in place for people to interact with each other. And things will be like a decentralization index. So Gini coefficient to understand the distribution power and influence within the economy. And this helps us to understand and evaluate whether, yes, this economy is good. They have high retention rate, they have high user acquisition. Everything is all good. But it turns out the decentralization index is not very high. So there's a huge inequality that we look at with people making the decisions and people using the product. So maybe in the short run, that's good because we have the financial incentives to allow the smaller fish to interact with each other. But in the long run, because the decisions are made by the people who have a larger stakeholder interest in a very different kind of growth of how the ecosystem will grow and how the ecosystem will change and how decisions are made and how governance will be shaping the future of the protocol, that could be a potential risk that you can look at from a protocol perspective. Then we also have wallet Gini coefficient and things like a player-to-protocol transaction rate. So from a player-to-protocol transaction rate, we want to understand the structure of the economy, the structure of the market, the structure of how people behave and interact in the ecosystem, whether it's EOAs, like to each other, or to contract addresses. So here we want to measure the percentage of economic activity attributed to users interacting with the smart contract or the platform as opposed to with each other. And this could make sense, for example, if you're a game. If you're a game and your game is about going to battle and people are interacting with each other, then you want to understand the growth of that percentage, that number, as opposed to smart contract where they're minting and breeding different kind of NFTs, or they're selling and going to secondary market to make that kind of exchange. Or if you are a lending protocol, then you want more people to be interacting with the smart contract to see that growth, to see that retention, to see more activity, real value generated in the system. We can start measuring and analyzing these things. From a lending borrowing perspective, if a lot of people are just trading with each other, because you can measure that based on whether their wallet has the Aave token, for example, and they're primarily trading with each other, that defeats the purpose of Aave, for example, because it becomes a peer-to-peer ecosystem instead of facilitating through smart contracts. And lastly, it's token design. So token design is it's a little bit more finance related, and the metrics that we look at is probably metrics that a lot of traders are looking at as well. Whatever we've been talking about so far is how operators are behaving, how operators are changing the economic system to make it easier to drive user acquisition or user retention growth. So here, the token design metrics are probably things that you've heard about. The amount of token in circulation, the net value to transaction ratio, token velocity, inflation rate, utility ratio. And the thing with these numbers, when we're analyzing risk, it's not just figuring out what the numbers mean, but what is the context behind the number. So it's not just token circulation, high, good. But what is the context behind that? Is there a reason? What's the qualitative explanation or policies that we have in place, the incentives that we have in place to drive that high token circulation? And is there any implications from a risk perspective? Are there any secondary and tertiary implications that could happen if there's a huge token circulation? So maybe token circulation could be high because there are more people coming in, and when more people come into the system, we're just minting minting tokens, which increases the token circulation supply. But if we correlate it back to our market design and we look at retention rate, the 7 days retention rate is actually very low. People just stay for 2 days and they leave. And that seems to be a trend in this specific protocol. And that's a very risky metric, that's a very risky ecosystem to look at when we are correlating the different kind of metrics in place. So these are things to consider, and it's not just, you don't consider these metrics in isolation. How do you compare them across the entire spectrum to look at from a macro to micro perspective? What are the risks in place? How does the micro risk metric impact the macro structure that we have created and designed? How does it impact the users interacting in this ecosystem? So that gives you a better understanding and better idea of how you do economic risk and analysis. And before I end, do we still have time for questions? No? Sure, okay. Okay, I guess I will not conclude then. But the last page, if you want to have, we run a consulting firm, and if you want a 15-minute consultation, you can click that link, and if you want to schedule a meeting with me, you can click on the other QR code. Thank you.